It's possible that we are in a completely fraudulent system.
Or you're wrong.
Sure. It's possible. Well, I just don't know how.
Michael Burry has owned shares in Bed Bath & Beyond before. On the 14th of June 2020, his SEC filing reveals that he owned 1 million shares in Bed Bath & Beyond, worth $10.6 million, which constituted 5% of his portfolio. His 15th of May 2020 SEC filing reveals that we see no Bed Bath & Beyond shares at all, and that's because of the fact that Michael had actually sold his holding at the end of 2019. In the period ending on December the 31st, 2019, the filing for which was submitted to the SEC on the 14th of February 2020, Michael Burry sold 750,000 shares worth $7.98 million. It is rumoured that this is because he profited to the tune of 40+% on his holding. So we see an interesting pattern, one in which Burry has owned the shares twice. First, he sold at a big profit, and second time around he still holds them as we speak to this day. He sees value in this company and is intending this time around on holding the stock for a long time. But don't hold me to that. I don't know the man inside out. So we're going to get in this video to the reasons why Bed Bath & Beyond is undervalued and why Burry likes this company.
Coming up today on Finance in 5.
So how do we judge that Bed Bath & Beyond is a company that's worth investing in? Well, one thing to say is that there's no point in turning the clock back and looking at how much the stock price was valued at 6 months or a year ago. What's key is looking ahead to future cash flows in order to form an opinion. Truthfully, it's difficult to do it, but we can get a quick idea based on how much cash flow is actually being generated by this company at the moment. As things stand, during 2019, Bed Bath & Beyond made just a little bit more than $300 million of free cash flow. Back then, it was very badly managed as a company. With some improvements, Bed Bath & Beyond could bring in more cash, but let's not forget that it's using its extra cash flow to pay down debt, which is one of the things that Burry seems to always insist upon of companies that he invests in, especially in the past GameStop and Taylor Brands, as we've talked about, even though that was a casualty of his previous investing. But let's not forget that as it's paying down debt, that's going to reduce the interest payments for Bed Bath & Beyond, and that will lead to appreciation in the share price as there's more recurring free cash flow. So what that means is that Bed Bath & Beyond is going to be trading for less than 7 times free cash flow, when most companies are easily trading for more than 15 times free cash flow. I mean, there are still some asset sales to come which are going to bring in extra revenue for Bed Bath & Beyond, 100 to 200 million by some estimates, as well as inventory liquidations, because it's going to be shutting down a lot of its brick and mortar stores, which is going to save it not only money in terms of operational costs running those shops, but also paying all of the wages of staff members who won't be needed anymore because they won't be working in the shops. So investors can even heavily discount those sorts of cash flow infusions by 30%, and the argument still holds that there's going to be $500 million in cash expected to drop onto the bottom line in the next 2 years. And this is what's the key thing that's going to determine the upward ongoing price trajectory of this company. Let's be honest, Bed Bath & Beyond is a retailer. It sells an awful lot of stuff. Here it even sells Christmas trees. If I wanted to, I could order 8-foot Christmas trees or 10 8-foot Christmas trees and have them shipped over. Obviously, I'm not going to do that, but it sells far more than just bath towels and bathroom apparel. It sells all manner of stuff for the home. It's really quite impressive. And the other thing that it did as well, it sold this personalized mall company for hundreds of millions of dollars recently, which I think is a US equivalent to a store that we have over here in the UK called Not on the High Street. We know for a fact that you can buy your merchandise from Bed Bath & Beyond cheaper from other places, like multi-channel retailers, eBay, other places online. I mean, as things stand right now, Bed Bath & Beyond is about $20. Who knows? It's possible that it might be turning around. I mean, if you look, for instance, at the S&P 500 level over the course of the last few months, and compare that with where Bed Bath & Beyond has gone, we see that Bed Bath & Beyond has spiked over 440%, whereas the S&P 500 has only gone up 35%. So there's been a massive outperformance of over tenfold. So it's easy to see the appeal of Bed Bath & Beyond from that perspective. Even though that there are a few risks that the company faces, the technical picture looks to be improving, and it would actually have been, according to one article that I read, the best performing stock during the last 6 months since April 2020. We know that it sells domestic merchandise and home furnishings, and it's one of the few companies in the retail sector that suffered a lot from the ongoing shift towards e-commerce. Problems that were also reflected in the above-mentioned stock price decline. And in the first quarter of 2020, March till May 2020, the company was also hit by COVID-19, which resulted in sales declining 50% year over year, and the company reported a massive negative earnings per share loss of $1.96 per share. But in the second quarter, Bed Bath & Beyond surprised the investing world with massive, humongous earnings, plus revenue topping analysts' estimates. Sales declined 1.1% compared to the same quarter last year, but considering the 50% decimation, the massive decline of the quarter earlier, this is still quite solid. Bed Bath & Beyond also reported a comparable sales growth of 6%, which isn't only solid, but it's the first quarter in which comparable sales growth took place since 2016. Also, strong digital sales, comparable growth of 89% was a very good sign that the company finally was moving towards e-commerce. Sales from the digital channels represented a third of total sales in that second quarter of 2020. It's possible in quarter two, according to one analyst's estimates that I read, that Bed Bath & Beyond could generate more than $750 million in cash, about $543 million in net cash provided by operating activities, and the other $245 million from the sale of personalizationmall.com. So when you look at the turnaround strategy, it was in a lot of trouble and it was losing out to competitors. So what did it do? Well, it got a new CEO, Mark J. Tritton.
My wife took us out for a drink and said he's going to bring in someone and they're going to turn around Bed Bath. She laughed. I was confused, thought it couldn't happen. How the heck did you do it so fast?
Well, we're still a work in progress. I mean, great green shoots of recovery and transformation. But I think this quarter really set aside evidence that we have a strong team, we've got a strong category, and we've got strong performance. So we're really excited to share even more on October 28th at our Investor Day, our blueprint for the next 3 years for our growth and recovery.
All right, well, give us a little snapshot, because I'm understanding that you got 2 million new customers, and they are younger than the previous base.
Yeah, they're about 6 years younger. The new customers coming on board, which is great news for us as we expand our customer profile. But really the key to that was our omni always strategy. And when we talk about that, we talk about really understanding our customer, how they shop today. And this was pre-COVID, but even more important inside that COVID moment. We know that 80% of our customers pre-shop online and either purchase there or go to store. And we had a really broken paradigm. We had a fantastic digital business. Really, it was very large. We did about $1.8 billion last year. We've already beat that by this time this year. So we're large, but we're growing. And we really doubled down on that digital aspect, but we weren't easy. We weren't convenient. I mean, life's tough at the moment, and you really want to make it simple and easy and frictionless for our customer. So we looked at our website. We looked at our integration with our stores, which is an ability to leverage our store assets and connect those two strongly into an omni environment. And it's really worked out, the introduction of BOPUS, curbside, and now same day, to really facilitate ease and frictionless shopping, starting with digital or in store, wherever the customer wants to go.
I'm glad you mentioned this, because it did seem to me that you made it so the stores are actually a positive, not a negative, the brick and mortar. And then second, the Bears were telling me, you know what, he's getting crushed on this BOPUS. He's getting crushed on it. When I read through, it seemed like the margins are better.
Absolutely, they're better. We know that if we have a digital sale that is BOPUS, curbside, or same day, our margin is actually equivalent to a store-based sale. So for us, we're driving behavior, driving engagement, and driving those three assets. And that's helping to leverage out our gross margin as we rapidly expand our digital business the stores are a key to this profitability.
They converted 25% of their stores in the United States and Canada into regional fulfillment centers, so that helped them nearly double digital fulfillment capacity. The company introduced buy online and pick up in store, which is another strategy that we know from Target, and that seems to be successful for Bed Bath & Beyond as it was for Target. Bed Bath & Beyond could increase the percentage of digital sales from 18% in the second quarter of 2020 to 32% in the third quarter. And these expanded fulfillment capabilities also had a positive effect on the company's gross margin. So aside from these strategic shifts, the company's also doing what many other companies that are facing troubles are doing. And what is that? Well, management is trying to reduce expenses. That's pretty much what all companies are doing at this point. Bed Bath & Beyond announced that it will reduce its workforce by 2,800 people, which is 5% of the workforce. So it's pretty impressive to think that they actually employ 560,000 people, and they're keeping all but 2,800 jobs. The company closed several stores in the past few months. It's planning the closure of 200 mostly Bed Bath & Beyond stores over the next 2 years, which should generate about $100 million in annual savings. So the company's also selling off assets like the recently completed sale of personalizationmall.com for $245 million, and management is expecting to sell further non-core assets. One of the risks that people are concerned about is the fact that Bed Bath & Beyond is late to the party, the e-commerce party, and it is a risk. We're going to have to see how things unfold with these strategies. Will these goals of increasing sales actually be fulfilled? Will these strategies to increase sales work in the coming quarters? We don't know. We're going to have a look at the second quarter results, but they should make a lot of investors more optimistic. Aside from the question, if Bed Bath & Beyond can manage to turn itself around, looking at the financial health of the company is important. On the 29th of August 2020, the company had $1.44 billion in cash and cash equivalents, which should provide enough liquidity for management to navigate the next few quarters if the situation should get difficult again and stores have to be closed again due to a second lockdown because of the pandemic. The other thing that the company did was stop paying a dividend in order to preserve capital. Who knows whether or not that was something that Burry told them to do. It's certainly a technique that he employed with success at GameStop and at Tailored Brands. And in this case, it will improve the financial situation of Bed Bath & Beyond. But we look at the liability side. The company's got $1,190 million in long-term debt, compared to shareholders' equity of $1,697 million. There's a debt-to-equity ratio of 0.7, which seems to be acceptable. Cash and cash equivalents would be enough to repay the outstanding debt. With the operating profit of the last quarter, it would only take 4 quarters to repay the outstanding debt. The last quarter was very good. So in the last quarter, Bed Bath & Beyond could also reduce the gross debt by over $500 million from its present level of $1.7 billion at the end of the first quarter. So to sum up, as I've said, the balance sheet looks pretty good. Bed Bath & Beyond, though, is facing a lot of risks. One of the major risks is the ongoing pandemic, but that applies pretty much to every business. We just don't know how it's going to play out over the next few months. We don't know if and when a vaccine will be found. There might be another lockdown. People might stay at home without a state-ordered lockdown due to the fear of getting infected. People might not have as much disposable cash to spend on bath-related paraphernalia. It was a good sign in the last quarter that Bed Bath & Beyond could increase its online sales, though. Increasing e-commerce operations is going to help, but the next 2 quarters during the fall and winter could be trickier and could be worse than the previous quarter. But aside from the negative effects of COVID-19, it might also be possible that Bed Bath & Beyond fails to turn itself around. It's trying a lot of different strategies that have worked for other retailers like Target, but we've got no guarantee that these strategies are actually going to work for Bed Bath & Beyond. Like most retailers, Bed Bath & Beyond is facing tough competition, and it's still operating in a low-margin business, so we have to be cautious. The fundamentals give some hints of successful turnaround. The technical picture is also indicating that Bed Bath & Beyond might have found its bottom. If the stock manages to stay above the previous high of $17.50, which at the moment it's about $22, I would argue that the downtrend of Bed Bath & Beyond might be over, and the pattern of lower lows and lower highs. Considering the initiatives of the new management team as well as share buybacks, I would say that a modest low single-digit growth rate should be realistic. I mean, I'd be cautiously optimistic about it, and I probably would stay bullish for the long term, but let's see how things pan out.